Welcome to SB Talks. Today is Monday, August 12th, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing a volatile ride for U.S. equity markets over the past 7 days, a hit to the Japanese carry trade, and the outlook on interest rates here at home following the latest RBA rate decision. Welcome to all our listeners. It's been a busy period since we last recorded. We've had the Fed meeting in late July, we've had the RBA August rate decision following June quarter inflation data, and a wild ride in global equity markets over the past 7 days. Where do we begin?
Yeah, well, there's a lot to talk about, I guess. So let's talk about the market volatility.
Yes.
and what brought that on. So we had about an 8% pullback in the S&P 500 from its highs. We had the VIX index, which is the fear index. It's a measure of implied option volatility, spike to an intraday high of 66, which is pretty much hasn't been seen since the pandemic and the global financial crisis.
And the VIX has been notably benign for a very long period of time, or certainly up until a few months ago.
Yeah, it's been tracking around 12, which is quite low. So it's a level of complacency or lack of fear. So we've seen really a very sharp reversal. And what brought that on? Well, there's a couple of things. I guess we've spoken a bit about the concentration in the market and crowding into the mega cap stocks, a lot of momentum buying. So it doesn't really take too much to trigger a bit of a reversal. Do you see that as, I guess, there's been a huge amount of momentum, a lot of sentiment pouring that way, just possibly that sentiment becoming a touch more fragile or eventually has to have some sort of pressure release? Well, that's right. It's like a spring, and when we have a little bit of a catalyst and we can see these sort of rapid unwinds. And I think also what you typically find is sort of late July, August is quite a low liquidity month. A lot of people in the Northern Hemisphere are on holiday. There's not much liquidity in equity markets. So it actually doesn't take too much to get fairly sharp moves in that environment. So what triggered it? I think there was a couple of things, a couple of data points. We had the ISM manufacturing survey in the US, which surprised to the downside. So it came in at 46.8, down from 48.5.
So which, a bit more weakness in the US economy.
Anything below 50 is contraction. So it's really saying that the manufacturing sector in the US is slowing down. So that made investors nervous. And then a couple of days later, we had the non-farm payrolls report in the US as well for July, which came in at 114,000 versus 175 expected. And I think, ordinarily a miss, we get some swings from month to month. Wouldn't be too concerning, but I think people were a bit on edge.
The compounding impact of those couple of data points.
So there's a couple of scares there, and the unemployment rate went from 4.1 to 4.3, which triggered this thing called the Sahm rule, which is a recession indicator. So basically what that says is if the unemployment rate rises by 0.5 percentage point within 12 months, which it now has, then generally a recession follows. Now, if you go back through history, every time the unemployment rate has risen by 0.5% in a short period of time, it's usually because of a recession. So now that's another recession signal. People saying, the US economy is going to slow sharply. This recession that we were talking about for the last 2 years is coming. I told you so.
Just a lagged impact of the rate increases.
And there was also some stuff going on in Japan. So the Bank of Japan unexpectedly lifted rates to from 0.1 to 0.25.
And let's talk about that because why would, I guess, Japan, once upon a time a very significant economy in the world, still a significant one, but probably a declining role over certainly the last 20 or 30 years from its peaks. Why would a change in the interest rate in Japan have such a significant knock-on impact?
Because a lot of people had been borrowing in yen, doing what they call the carry trade. So you borrow in a cheap currency where the interest rates are very low, and you take that money and you convert into a high yielding currency and invest that and earn the carry or the spread between the two interest rates. So interest rates in Japan had been 0, now they're 0.25, and in the US they're 5.5% roughly. So there's a big difference. And people had been using the Japanese yen as a bit of a carry trade. That had helped weaken the yen to the lowest level since the early 1990s. And people had been borrowing money basically in yen. So it was a leveraged trade. And so you'll get a bit of clink in that, when people suddenly think, interest rates could be going up. The currency starts heading in the other direction. So the yen started appreciating.
And suddenly the cost of their borrowings, not just in interest rate terms, but the capital terms start to increase. And people quickly rush for the door.
That's right. So another unwind of leverage, if you like, in the system, particularly hedge funds doing that trade. So I think all these things sort of conspired at the same time.
They all sort of feed into the early part of last week where the market did take a major move downwards. But we finished on a much more optimistic, or I don't know, sentiment returned. What's your take on how the week rounded out?
I think what happened is people they looked into the details. So they reacted when the headlines came out. They reacted, and then more sensible heads looked at the detail and said, "Oh, the U.S. unemployment. Yes, there was a lot of people off work due to weather-related events. There was that Hurricane Beryl, and then there were some issues in California where people were off work. There was some temporary layoffs." And those things can tend to kind of flip around the next month.
Yeah.
So people go, and also the unemployment rate went up because there's more people that have entered the workforce. So
supply.
The participation rate went up. Supply has gone up, which is normally a good thing. It's not weak demand that's causing the unemployment rate to go up. It's supply. So people looked at that. And then we had the ISM non-manufacturing report early, I think it was on Tuesday of last week. And so that was quite stronger than expected, showing the services side of the US economy is doing reasonably well.
Which has kind of been an ongoing trend that services have been really propping up and potentially still the lingering inflationary driver as well in the economy.
Yeah. And then we had the weekly jobless claims. So these are the number of people losing their job and filing for unemployment in the weekend of 29th of July. And that fell from 250,000 to 233. So people going, maybe it's not that bad. And, there's also a lot of auto workers in the US. They often close down plants for retooling. If they've got a new model, they use the opportunity over the summer to retool their plants. And so they lay off workers. So you can have some bumps, if you like, in unemployment at this time of the year. So people, I think, chilled a little bit as some of that
looked deeper.
Some of that data came in, and the VIX has fallen back to around 20. So still relatively elevated relative to kind of recent history, but certainly nowhere near the 66 that we saw intraday. And the Japanese stock market, which had its largest single day fall since.
I think it was 87.
87, the 87 crash. October crash. That rebounded 9%. So people are now sort of settling down.
Digesting it all. But probably fair to say we might be heading in, as you've talked about actually before in the podcast, we're probably heading into a period where the markets are probably just going to be not necessarily that extremes of volatility, but probably less one-way traffic in the sentiment and momentum. And that's natural after what we've seen over the last 9 months.
Yeah, I mean, to put it in context, in a normal year, you get a 10% pullback in stock markets, and it usually finishes the year higher, but you might have this, kind of pullback of 10% plus or minus. So we've had an 8% pullback, so not even that extreme relative to kind
probably
of history.
Just that it happened in such a compressed period is what really caught attention there.
Yeah. So I think it's good. If I look at some of the sort of equity sentiment and positioning indicators that we look at when we're kind of formulating strategy, they've gone from very extremely optimistic levels, the sort of the greed index, and they've plummeted to sort of more fearful or cautious. So I think that's probably healthy, just to remind people the markets don't go up in a straight line.
That gives you a little bit more comfort as an investor that it's not quite so optimistic.
Absolutely. But I think the market will probably be a little on edge, for the next few weeks. It'll take a while. We've got the US CPI report this week. If it's another benign reading, that'll probably be good. No surprises.
Well, let's talk to that actually. So in the last couple of weeks, we had the Fed meeting there the last couple of days of July. I don't want to go as far as saying sort of planting the seed for rate cuts, but they're beginning to move in that direction.
Yeah, they didn't overtly signal that there'd be a rate cut, but they said if the data basically continued on its current trend, i.e. 0.1%, 0.2% CPI numbers per month, then that would be sufficient for them to consider a rate cut. So it was a nod, particularly by Chair Powell, that that would be maybe considered without overtly saying so. So it really requires a continued run of kind of softish CPI numbers. So this week's one will be important to get that. And markets are priced for 37 basis cuts at the September meeting.
Okay.
So more than one cut is currently priced because of these lingering fears of a recession and softening employment picture.
Yeah. Okay. Maybe actually come closer to home then when we're talking central banks. We've had RBA's latest rate decision as well, and we've had the June quarter inflation data as well since we last recorded.
Yeah, so the June quarter number was better than expected.
Or not as bad as feared, perhaps?
Not as bad as feared. Yeah. So I think that we've seen a bit of a disconnect between those monthly CPI numbers, which we've spoken about before, don't give you necessarily the full picture, the full CPI basket. So we had two of those that pointed to a sort of a 1.1% quarterly CPI. And in the end, it came in at 0.8%. Which was the RBA's forecast. So that was good.
Big sigh of relief there.
Big sigh of relief. Yeah. That said, the RBA is still characterising inflation as too high. They think there's still excess demand in the system. The economy is demanding more than it can produce.
Very strong rhetoric following the meeting, I'd say. There's very wanted to make clear statements around, I think, managing expectations.
Yeah, so we got a new set of quarterly forecasts from the RBA, the Statement of Monetary Policy for August. So that came out, and we had Governor Bullock give a press conference after the meeting. And I'd say both of those things really paint a picture of an economy, as I said, running a little bit too hot, notwithstanding some of the, sort of softish consumer spending, which was spoken about previously. But generally, we've got all that federal government and state government spending on infrastructure
causing all
and
sorts of pressures
health,
at certain points.
Health services and things like that. And then we've got some tax cuts coming through and some cost of living subsidies and things like that. So these all add up, and then strong immigration growth as well, which is obviously pressuring housing. So rents and new home construction costs are quite high. They're running at about 5.2% year on year. And that's a decent chunk of the CPI basket as well.
Now, the fear had been leading into this meeting that had the inflation figure come out worse than had been projected, that they would have their hand almost forced to have to make another move up. What's your take on where we sit now?
Well, they certainly debated another rate hike. If you believe Michelle Bullock. So it was certainly either a hike or keep it on hold, and that was what was deliberated at last week's meeting. I think you can't take a rate hike completely off the table, but that's a high bar for it. I think the preference would just be to keep rates on hold at the current level, and it was reported in the press, and Michelle Bullock kind of nodded to this, that really rate cuts are not on the agenda between now and the end of the year, even though the markets had been pricing in around 50 basis points of cuts. So she really pushed back on that and said that's not something that they would be that they're actively considering. Now, of course, everything's data dependent, and if we get if we got a terrible employment report and we get another one of those on Thursday, then things can change. But as we sit today, the RBA is really pushing back on the idea that rates will be coming down this year.
Definitely driving that rhetoric to, I guess, what they don't want is everyone to get really excited that rate hikes are done and potentially cuts are on the way, and then to really see that second wave of inflation. Yeah. So they want to really, I think, manage it carefully from here to the end of the year. Yeah,
their own forecasts, as I mentioned, we got a new set this last week, show inflation not returning to the midpoint of the target band until now, the end of 2026. So that's more than 2 years away, So they're really saying they think inflation's going to be sticky. It's going to take longer to come down, and they need to keep rates where they are for a longer period of time.
Terrific. All right. Thank you, Nick. That's an excellent overview as always. Thank you very much. And thank you to all our listeners.